Building an investment bank from scratch is no small feat, but in less than 2 years, ArcStone's Securities has carved out a bold space in North America's financial landscape, with a new partnership giving the firm reach across 400 US advisors and $15 billion in assets. ArcStone is betting on cross-border deal flow at a time when markets are volatile, regulations are tightening, and investor appetite is shifting. From gold's record run to the growing role of Bitcoin in corporate treasuries, the investment environment is full of both risks and opportunities. Well, to unpack it all, I'm joined by Michael Astone, CEO of ArcStone Securities and Investments. Michael, it's a pleasure. Thanks indeed for coming in.
Thanks a lot for having me. Good afternoon. Thank you.
Well, listen, you've built ArcStone from scratch in just 22 months. I'm wondering, what gaps were there in the market for you to be convinced that there is room indeed for another independent investment bank?
Sure. So after spending 15 years growing my career at Tier 1 investment banks, working at BMO, Cantor Fitzgerald, I saw with a team of folks a big opportunity in the small cap, mid cap space to really help these public companies, private companies looking to go public with a cross-border platform. A lot of the firms after the MiFID rules looked at their ECM desks as loss leaders. And so we decided to build the bank with the desk. That means connectivity with institutions, family offices, and retail wealth. And with so much capital having flocked to the USA after COVID, many of our clients have set up family offices. Many have moved to Miami, Bahamas. The importance of having a cross-border investment bank was just really parallel, and especially with a lot of US firms coming to Canada. Many of them don't understand the Canadian markets. Many of the US banks coming to Canada are so large. And so having a player that understands the $100, $200 million market cap companies and really knows how to specialize in uplisting, that's the void we saw.
I want to get into the hurdles in a moment, but first let's focus on this Kingswood project, right? It opened the door to 400 advisors. You've got $15 billion in assets. How essential was that US footprint to your strategy?
So we started with the acquisition of ArcView Capital. We announced that in September 23. That firm was started in 2019 as a New York-based FINRA broker-dealer. And we went off to build this investment bank, and we came across Kingswood. And Kingswood is a roll-up of retail wealth asset managers. The CEO, Michael Nessum, is a former retail wealth broker himself. They opened up a subsidiary investment bank right around the same time we acquired ArcView Capital. We started having conversations. They knew what I had done in my predecessor firm, and they were looking for a team to help them execute on their investment banking build out. And so after talking with them, we said, hey, this would be a great partnership because many of our managing directors sit in Toronto on Bay Street. We understand the Canadian license regime, the EMD, the IROC regime. You don't have any licenses in Canada, so why don't we partner up? By the way, many of our managing directors, including myself, spend a lot of time going to family office conferences, Bitcoin conferences, all on US soil. And so we can be doing US deals together as 50-50 partners. You have this great retail distribution system. We're building up this amazing family office system and institutional system. And so it's just a match made in heaven, really. It really worked out well for both organizations. We've seen Roth come to Canada with Roth Canada. We've seen Stifel come to Canada with the acquisition of GMP. We've seen Cantor. We've seen Jefferies. So all these mega banks are coming into Canada. And to have a nimble firm like ourselves, where when you're going to the new names committee and you're presenting a $10 million financing, that's a $600,000 to $800,000 fee at 6 to 8%. Many of those big banks are going to say that doesn't meet our minimum fee, because they're such large organizations. So when you have the ArcStone Kingswood, who could be more nimble, we can be working with a lot of these companies and helping them on their journey. But we have retail wealth. A lot of the competitors, it's very unique to have this cross-border platform with retail wealth. Many firms are just institutional only nowadays.
Theory is one thing, but against that backdrop, in practice, how do companies face up with the challenges in tapping into investors both in Canada and in the US? There are hurdles there, right?
Big hurdles. So the stock market has all become, and it's always been about storytelling, connecting with investors. We've seen a shift of fundamental small cap funds The number of small cap VC funds in Canada supporting public companies is down. You look at the 10-year chart, there's been consolidation. The fund managers and some of those portfolio managers who were supporting small cap companies, mid cap companies, their funds have ballooned from 200 million to $1.5 billion. So they need to be putting to work $25, $50 million checks at a time, because that's what really moves the needle if you're a portfolio manager, one of those firms. Now, if you got a $100 million high growth company, bringing them to see a fund that wants to write a $20 million check becomes problematic, because that's like 20% of the company. So here comes the importance of talking to the family offices, retail investors, and having a retail wealth system. Not only that, is many of these companies are being born in Canada because they're a $50 or $100 million company. And then as they execute 6 quarters, 8 quarters, we're seeing them uplist to a NYSE American Exchange, to a NASDAQ or dual list, so they could tap into both sides of the border, because we're still seeing a lot of TD Ameritrade, Robinhood. Many of these brokerages will not allow retail investors to buy Canadian small cap listed only stocks, even though these companies are getting the OTC listing. They're simply, these brokerages can't handle. So it is above and beyond theoretical. In practice, having those retail advisors at Kingswood, having the family offices, having our email subscriber system, that creates more eyeballs. It creates more trading liquidity. It creates more share price appreciation, gets the story out. And that ultimately leads to re-rating of these public companies and better future equity deals for them.
Yeah, it's about the sequence of accessibility from what I'm hearing, right? Okay, licensing front. Yeah. I mean, that's another thing. You're pursuing additional licenses both in the US and in Canada. I'm wondering, on the regulatory side, again, that's another challenge there, right? I mean, how do you navigate through that? And how important is that compared to the actual partnerships themselves?
Absolutely. Look, navigating the regulatory acquisition partnership landscape was something very unique, very challenging. We have a fantastic team. Jack Ben Simon on my team, who's managing partner, did a phenomenal job. When we set out to buy ArcView Capital, we went through a rigorous FINRA audit, including the continuing membership application. It took us over 2 years to get that through. Lots of, as you can imagine, background checks, monthly audits, procedures. We had to enroll many of our MDs into FINRA exams to upgrade their own licenses so we could bring more licensed professionals onto the dealer. We hired, additional managing directors and are still in growth mode, growing that part of the practice. In Canada, we are in the midst of pursuing a transaction which will expand our licenses as well. But really, this is about giving back to all of our clients. We want to be full service. We want to have multiple products for them. We want to be able to deliver their research in Canada. We want to be able to deliver their research in the US. We want to have retail wealth in Canada, and we want to continue to grow our capabilities. So it's been an interesting challenge and opportunity for the business, but we've done a lot in the last 2 years.
And you're doing that at a time when gold prices are just at record highs, okay? And with that comes this erratic market, this volatile market. How do you sort of keep clients in check and companies in check here to sort of navigate through that? That's not easy. Where do you see the cycle, if I can extend the question right now, by the way?
So we've seen, we're in a bull market.
Yep.
It was perfect for us because when we launched the acquisition, 2023, markets were a little sleepy in Canada. Metals and mining was still in a tough spot. Gold was probably around $2,500. Liquidity on CSC, TSXV were low. So we were building at a time when markets were just coming back and we were getting deals done south of the border. In fact, we thought we wouldn't come into Canada until about 2027 because we had the FINRA broker dealer, we had the Kingswood partnership. So we said, let's grow in the US. We'll deal with Canada after. It's in a tough spot. Now, simultaneously, while we're doing that, in and around 2024, summer of 2024, you start to see liquidity come back into risk names. You start to see a lot of high growth spec names get their share price appreciated. And then you see all these metal and mining companies. So we saw capital first. Gold hit over $3,500. We saw the tier ones react really positively. Now we're seeing the juniors. We're starting to see financings get done. There's junior gold companies whose stocks are up 300% in the last 4 months alone, and now they're starting to come to tap the equity market. So
because capital is flowing there, right?
Capital's flowing. We think rates are coming down. You're seeing that both US and as well in Canada, given the state of the economy. That's good for equities. More and more people are pulling money out of real estate and mix and other passive investments, and now going into equities And now Bitcoin is becoming more mainstream. They're seeing what the president is doing down in the USA. They're seeing dollar devaluation, decoupling. And so more and more people are looking for alternatives for their portfolio, whether it's their RSP, TFSA, and they're going into the equities of these junior companies, crypto, blockchain, metals and mining, so they get more torque because they may have missed that initial rally in Bitcoin from 10,000 to 120. So they're looking for ways to catch up. And same with metals and mining. Not a lot of them hold precious metal, gold, silver in their portfolio. So now they're going into the miners as a way to catch up, which is good for our business because many metals and mining companies are coming to us saying, hey, we want exposure south of the border. We want to do some retail shareholder marketing with your reports.
Yep.
And we want to eventually uplist because we know a lot of capital's flown to the US. So we need a firm that understands both north, south of the border regulations and how to do it.
I want to wrap up by looking at your growth summit, right? It's coming up here in Toronto.
Right.
And I'm curious, who's attending? I know you'd be facilitating. You tell us a little bit more about that. And then this is all about mood among investors, isn't it?
That's right.
I mean, is it risk-taking? Are they cautious? What are you reading right now as you head up the growth summit?
So our growth summit's next Thursday, September 18th at the St. Regis. Really, that's a platform for public companies to interact with institutions, family offices, retail investors, high net worth deal makers, and as well capital markets professionals who can help their business, whether it's digital marketing, IR providers. We do that as a venue to really bring everyone together. Given there's so many events that have happened now south of the border, we thought there's so much dry powder on the sidelines in Canada, especially on Bay Street, and now even more with this metals and mining's run, where a lot of Bay Street's been cashed up. And so we're bringing these public companies into the mix. Many of them are flying in. We have a number of family offices flying in. We have a day of presentations in a main ballroom, but then we have a second floor with one-on-one meetings. So it's getting their story out there, helping them augment their shareholder base, introducing them to check writers who weren't be traditionally covered by many of our competitors. Many of our competitors aren't covering a $1 billion real estate family who likes to write $1 million checks into gold companies. Someone who made $200 million on a psychedelic company and now runs his own family office and puts $3 million into deals. And so in addition to the traditional institutions that I view those as table stakes, all the banks know who they are. We all call on them. We all share deals. Our edge is going into the non-traditional sources of capital because some of these CEOs and some of these public companies, they might need help with open market buying and having these family offices come in to support their story if they like it. And that's really what this growth conference is about. It's our second flagship conference. So we're excited about it.
Yeah, now the flexibility sounds enticing. Well, look, it really is compelling. Michael Astone, CEO of ArcStone's Securities and Investments. Thanks very much indeed for talking to us.
Thanks a lot for having me. I really appreciate it and look forward to seeing everyone on the 18th.